Hello, everyone. Welcome to today's webinar with me, Fawad Razaqzada, market analyst with Think Markets, and in the room is my colleague Victor. Hello, Victor.
Hello, Fawad. Anxiously looking forward to this final week of proper trading. As you know, maybe our listeners don't know, but me and Fawad can tell you that the time between Christmas and New Year's Eve is supposed to be enjoyed with your loved ones instead of trying to trade the market, which at that time is so illiquid that the only thing that you might achieve is to get killed.
I tend to agree with that. Although having said that, I can't remember once I did trade between that time. But no, it's generally it's going to be very quiet. I think the markets are very quiet unless something big comes out, like in terms of Omicron or something like that to move the markets. But in terms of macro data, there's nothing to move the markets at that time. The only exception is if you have positions open that you'd like to keep open heading to the next year. In that case, you can look to manage your positions, but I wouldn't advise trying to look for new opportunities in that week. But anyway, these webinars are for general information. They're not intended to provide trading or investment advice or personal recommendations. Any information relating to past performance of an investment does not necessarily guarantee future performance. Think Markets shall not be responsible for any loss that you incur, either directly or indirectly, arising from any investment based on any information in this webinar. Please remember that spread betting and trading CFDs carry significant risks and may not be suitable for all investors. So yeah, this is our final webinar for the year. Thank you so much for joining us. For those of you who are watching a recording of this, please consider joining us live in the next ones that we have available for starting in January. You can do that by going to thinkmarkets.com and going to the webinar section, and you can register over there. Now, as you can see, the market's been quite choppy in terms of indices, but here I have the dollar index, and I think we should start with the FX markets, and then, or shall we, Victor, let's start with indices because they've been more volatile, haven't they?
All right. Yes.
Yeah.
They've been more volatile in recent sessions, primarily due to the continued uncertainty as to how the markets will digest higher interest rates, I think. Although some people are still focused on Omicron, but at this point in time, I'd rather not be too focused on that, because it seems as if while case numbers are increasing rapidly, the severity of these cases seems to be benign mostly, especially in countries where people are vaccinated. These cases are, like the case numbers might seem very, very high, but in reality, ICU beds are still vacant. And yesterday, the UK decided to reverse on some of the pre-Christmas measures they have announced. So, I think the theme is back into the rates environment and the capacity of the market to handle higher interest rates as incoming.
So the only thing I would add to that is that although it's not as severe as first thought, the only thing is that a lot of countries have announced lockdown measures or restrictions, like the Netherlands, in Germany. People from the UK cannot easily travel to any of the major European countries at the moment. So that travel restriction and some sorts of restrictions here and there, they are going to cause weakness in demand for things like crude oil, weakness in the economy as well. So that's going to be something that investors have to take into account. But overall, as Victor mentioned, it's not as bad as first feared. So the focus is slowly shifting towards interest rates once again. But I've got the German DAX index here. You can see the initial panic, and then we rebounded. Since then, we've sold off as sellers came in and stepped in right where they should have at resistance, the shaded gray area. And since then, the market has kind of broken down, moved below the 200-day moving average. We've established a bearish trend line on the DAX. So the path of least resistance is still to the downside, I would argue, for the DAX and many of the other indices, until something fundamentally changes, or at least we get a technical reversal pattern in place. So far, I don't think we've seen a reversal in terms of a bullish reversal. So the more likely outcome, the more likely outcome it appears at the moment is that we are going to be headed lower in the next couple of days. Let's see if that changes today, because the markets have bounced back. We had some decent news from corporate front. One of the major retailers, who was can you remember which retailer it was? I can't remember. They reported a really strong set of numbers.
I haven't really paid attention to earnings reports, unfortunately. So no, I can't help you on this one. But was that the reason why stocks rebounded yesterday?
Well, part of the reason, because there's not much news going on, so people are finding any excuse
looking for smaller catalysts.
Exactly, yeah. Anyway, that's not a major issue. So that's the situation with the DAX. If you look at the United States markets, the US, the S&P 500 still holding its own above the 1-year-old bullish trend line. So the trend is not broken in that sense, but we have seen some weakness in the recent trade. Although
some of
no
the
follow through
of the index, particularly, I'm referring to the most popular one, Tesla Motors. If we look at that chart, it's testing a very, very important level around
let's have a look at it.
900.
It's somewhere here.
Let's give you a T.
Maybe we can
TT. No, just scroll over. It was there. You missed it.
Shall I go up or down?
Down. It's in alphabetical order.
Oh, it's in alphabet.
So just go to T.
There you go.
And there you go.
Okay.
So you have marked it here, the 900 level, which was previous resistance, now turned support, and potentially a support. Doesn't seem like much for now.
Well, the markets haven't opened yet, so obviously.
The market has closed on that level, and we could be looking for a protracted move lower in Tesla if this level breaks.
Speaking of Tesla and other technology companies, we have seen some insider selling. Elon Musk has sold lots of his shares to pay for a huge tax bill. But the fact that he's selling is something that the market hasn't not noticed. Also, other technology CEOs have started selling as well.
Other techno kings such as Jeff Bezos, who has unloaded a huge chunk of Amazon shares.
So whenever you get insider selling like that, it does tell you something. It could be that it may be nothing significant, but it may be that they think their companies are overvalued. and they'd like to take profit.
Well,
and
if anyone knows, it's them.
Exactly. So the market has responded. I mean, if you look at other technology stocks, should we look at Apple maybe?
Well, perhaps the only stocks that haven't dropped materially are still those technological mastodons, really.
Yeah.
Like Apple, Google, Facebook. Well, Facebook actually did
As Google
dip in recent weeks.
Yeah.
It started after the Meta announcement, really. Didn't help much. As who would who would buy this thing just because it's renaming itself? But anyway, the pressure on the regulatory pressure on tech giants is still likely to become higher rather than lower. So the Nasdaq itself has been kept up by the likes of Microsoft, Google, Amazon, Apple. And this is something that the traders should pay attention to, because while the index still hasn't
broken down completely,
there is like this level yesterday seems to be the line in the sand.
Around this area,
now a strong level around 15,500. Or thereabout. This seems like the new line in the sand. The traders yesterday who were betting on a breakdown got squeezed higher, and that's something that we should continue to pay attention to, as this level opens the way towards the uptrend line, which you just shown. You just highlighted for us, and it's the uptrend since the 23rd of September 2020. Good luck with holding your positions long when that breaks.
I think I don't think this selling is done yet. I think that
doesn't seem so.
The way it's shaping up, it looks heavy to me. I could be wrong, of course, but
whether or not the market will wait until after Christmas, or it will bring up a nasty Christmas surprise to some people, we'll see in the next couple of sessions. But what are the catalysts over the coming 3 days? Is there anything materially important in terms of
not really
economic news?
No. I mean, if you look at the calendar, what do we have? Let me just filter it in terms of market impact. The only thing we have, consumer confidence in the US, existing home sales, core PCE price index on Thursday.
Yeah, but I guess core PCE is not really, it's not really different from the trends in CPI. I mean, it's probably going to
There's
be
nothing on the calendar in the Christmas week.
So it's a sentiment game at this point in time. And that can be a very unpredictable matter.
Speaking of the economic data, things will pick up quite rapidly at the start of next year. We have OPEC meeting. That's going to be very important this time because of the Omicron spread. Are they going to slow down the production increases? Production has been coming back from the OPEC by about 400,000 barrels a day. are they going to slow that down? Because oil prices have fallen, and there are concerns about the economy with the countries restricting travel and everything else. You have lots of data from the US. We have FOMC meeting minutes. That's going to be important. And we got NFP, non-farm payrolls, on Friday as well. Not to mention Canadian jobs report as well. So lots of things to look forward to in the first week of January. And we do have a webinar scheduled for the 4th of Jan. I'll be back. I'm sure. Victor, are you back in the first week of Jan as well, or are you going to be off?
No, I'm still going to be off.
Okay.
But I might jump in just for the webinar.
Okay, you don't have to if you're away. But yeah, at least one of us will be there to the webinar on the 4th of Jan, and we have the NFP preview webinar as well on Friday at 11:30 London time. So there's 2 webinars happening in the first week of January. You can register for those, of course, by going to the website. Okay. Anyway, going back to the market, I was going to mention the 200-day moving average on the Nasdaq has not been tested since the height of the pandemic back in April, when we broke back above it. We went below the 200-day moving average for a few sessions or a couple of weeks maybe back in March 2020. And then once major central banks announced all those stimulus measures, we broke back above it, and the index has not looked back since. So perhaps a retest of the 200-day moving average is overdue, I would say, and maybe this current phase of weakness that we're seeing could lead to a potential retest of the 200-day moving average in the coming days. But the 200-day is really important for the Nasdaq and indeed many other indices, because most of the time it has spent above it in this strong bullish uptrend, and the weaknesses have been very the moves below the 200-day moving average. They have been very brief. So if and when the 200-day moving average breaks and the market there's acceptance below it in a sustainable manner, then that's when the wheels could come off this major stock market rally. So in other words, the weakness that we are seeing right now could just be a small dip. It might not matter too much in the grander scheme of things, but eventually, whenever that is, we go below the 200-day average on a sustainable manner, then that is when the long-term trend could well turn decisively bearish, right? So if you are trading the market, the indices at the moment, just because you've seen a bit of a breakdown, don't think that this is going to lead to a significant drop. It may well do, but the odds are stacked against you. So the way I would trade it is go from one level to the next and look for the next opportunity until the market creates a major reversal, long-term reversal, because we have not seen that long-term reversal yet. So bear that in mind. And indeed, if you look at how the market has bounced in recent days, it underscores the need to take profit at support. For example, in here, the market sold off from this area of resistance. It bounced really sharply. That drove the market back all the way to that resistance level again. So if you didn't take profit at the trend line and this area of support, you would have missed out on all of that unrealized profit. And again, when it sold off from here, it's taken like 2 or 3 days to then continue moving lower. So it's not like a immediate downside follow through. And now again, from the low of around 15,500 here, it's bounced all the way to 15,800. That's like 300 points of or nearly 300 pip move, which is not insignificant. So in other words, if you are shorting or indeed going long in this type of market environment, take profit at least on a large portion of your position at support or resistance when the market moves in your favor. What else are we looking at, Victor? Should we look at some of them?
I think that the FX is the next one on our plates. It's another week of tightly range-bound trading. Those central bank meetings last week didn't manage to help out. And
they kind of canceled each other out.
Continue to be, we continue to be stuck in a range.
Yeah. So the uptrend still remains intact, I would say, for the dollar. We haven't broken down. The trend line is in place. We are above the 200-day moving average and above key levels. One thing to note, I don't know if I have it on this chart, but if you look at the historical charts, the market tends to find a bottom or a top at the turn of the year. So in January or in the first quarter. This is important because if you're trading FX, be wary of the dollar potentially finding a top in the first quarter of next year. If you look at here, for example, this happened in the first quarter in January, right there. This was the low. If you look here, okay, this is not a great example, but if you look at some of the tops, for example, here, see that's January as well. The dollar index stopped in January. This line here, March, that's in the first quarter. This low here, that's in January as well. So you see, start of the year is very important in FX. This high here in March, so in the first quarter. One of the reasons that the market tends to kind of bottom out or top out at the early parts of the year is because a lot of major central banks will have made their policy decisions at the end of the year that has just ended. So in this case, in December, we had so many central bank meetings who provided guidance in terms of what the interest rate outlook is going to look like in the coming year. So by the time the next year starts, a lot of people will have digested the data, the messages from the central banks, and they start to look for different types of trades or investments, and that's why you tend to see the dollar top out or bottom out in the first quarter, or tends to do that anyway. So the dollar has been on the rise this year, and if I go and I show you the yearly chart, this is the yearly chart, right? Every candle is 1 year of price action. Last year, a big red candle, right? This year, we have seen no follow through on the downside whatsoever. But we haven't broken out of the ranges from the previous year, meaning that overall the dollar remains in a long-term consolidation. Yeah, so just because the trend is bullish right now, it doesn't necessarily mean that we'll continue to push higher. We are stuck in a long-term consolidation range. And most of the reason for that is the fact that the euro hasn't moved much in a meaningful way in either direction, because the dollar index is 57% the inverse of the, is it 57% or 54% the inverse of the euro dollar, basically.
I think it was around 50. Yeah, 54, I think.
Yeah, well, we can find out. Dollar index. Oh no, not Investopedia. Wikipedia.
57.6.
57.6%. Yeah. So the euro has the largest weighting on the dollar index, then the Japanese yen with 13%, followed by pound and Canadian dollar. Let's look at the euro dollar.
Let's focus out, on
Shall
some
we?
pairs.
Yeah.
The
euro dollar.
So the euro had some sort of a bounce yesterday after the news that the new Bundesbank chief appointed by the German government is likely to be rather hawkish.
All right.
So that was something that the market digested as a positive news for the euro, although I still don't see how a single hawkish member can turn the whole governing council of the ECB into more inflation-focused body.
Yeah.
So well, it remains to be seen whether that's really something or just a fad.
Yeah. Do you still think we are headed lower, or do you think that the downside is effectively done for the euro now? Because previously you were quite bearish on the euro, and rightly so, because back at the start of the year, I didn't think the euro is going to weaken, but you were very spot on with your macro forecast, and you say that the euro is going to go down this year, and it did.
Yeah.
So
at this point in time, the risk reward is not that good in terms of shredding the euro from here. Okay. However, I do feel like we still haven't seen the bottom yet. So as we previously highlighted with you, we do have this uptrend line on a multi-month basis, if I'm not mistaken.
Yes.
Around 110 or thereabout.
Yeah. Let me just bring up this chart. I think.
Yeah.
This is the.
Yeah.
Let's go to the monthly chart.
This is the one. This is the one around 110. Yeah, we're still consolidating in this area between 112 and 113, and we need a confirmation to the downside to open. If we don't get that over the next couple of weeks, really, we might have seen the bottom in this cycle for the euro. But for now, it seems like the dollar is trying to muster up some strength and make another go at the 112 level, and consequently open the yearly low around 111.80, or what was it, 70?
111.86.
Okay, yeah. So yeah, that's those are the key levels to watch. I feel like today's visit to 113 was rejected. Well, there's still a lot of time during the session. The US hasn't come up to the market yet, so we might see some euro buying from the US, but for now it seems like 113 has held. If you move on to the 1 hourly chart, yeah, so the 113 area has been tested yesterday evening during the middle of the US session, and in London morning today. Buyers have proven to be unconvincing. They didn't manage to break above on both occasions. But now, in order for the downside to open for a test of 112.30 and 112.20, which is the post FOMC low, and it's quite important. So I feel like a break below 12 70 is necessary in order for those levels to open up.
Sure. Yeah, I don't have anything else to add to this. Anything else that's moving today? Oh, the Turkish lira has been in the news.
Oh my God.
Yeah. Let's have a look at the Turkish lira. This is what's happened this
if
week.
If you don't have any heart issues,
yeah,
you're free to try trading the Turkish lira.
This is surely a big reversal now, isn't it? In the trend, you know. The lira
what
has been,
happened? What was the trigger for this reversal?
I think the government announced some measures to stem the outflow of the lira. I think some real economic measures.
They did something crazy, like announcing that they're going to support depositors in some extra way, or it's some very unorthodox tightening without tightening.
they introduced a series of steps, and to put it that way, it wasn't one single measure, but that looks like it has reversed the trend, and it looks like I was reading some article, and it said that around $1 billion was sold in the markets after Erdogan unveiled the measures. So that's what kind of reversed the market. $1 billion, not insignificant. And people
it's almost a 40% rally from top to bottom.
Yeah, it looks like that. Yeah. Let's have a look.
Yeah, well, Turkish lira traders.
Because everyone was positioned short on the lira, wasn't it? So that move seems to have caught people, and maybe lack of liquidity as well.
It's exactly 40%. 40%. Not exactly, but 39.3%.
Now it's only 30%. So
yeah.
But anyway, that's what triggered the move. Big reversal here. Let's hope that this is the end of the downtrend for the lira, because people over there they are struggling. Obviously, everything is priced in the lira, and the weakness means that everything has been doubled for them, price of everything. But hopefully now that the tide may have turned, and we may see some strength come back to the lira. But let's see. Erdogan is someone that you can't,
it's an unpredictable.
He's a very unpredictable chap.
Although, like the ones that what was it, like 5 or 6 years ago, when he kind of usurped his power, selling the lira at that point in time, basically has proven to be the smart move.
Let's have a look at some commodities and then wrap it up. Crude oil remains in large range. We've seen sharp moves in either direction within this area, all to do with Omicron, and people are not now taking too much, too significant positions ahead of the OPEC meeting on at the start of January, which is going to be very important, I think, for crude oil. So oil remains inside a long consolidation range.
A rather large range.
Sorry, large range. That's what I mean.
Drop around 6% yesterday. That has been largely clawed back.
It only ended up around 1.6% lower after being down like 5 or 6% earlier in the session. But we are back at the base of that breakdown around the $70 per barrel on the WTI contract. We are below the 200-day moving average as well. So let's see if we get the renewed selling pressure coming in at around these levels. But if we go back above 70 and close above, then that would pave the way for a potential rally towards 75. this shaded blue area. Similar picture in terms of Brent. Brent has been bouncing at $70 per barrel every time it comes back to it. Already we've seen at least 2 occasions where it has rallied quite sharply from there, once here, although then we saw a temporary breakdown, but we've bounced quite strongly from that 70 again to rise to 72.60 today. Here it is testing resistance or potential resistance. Previously this was support, so it could possibly turn lower from here. Just keep an eye on the shorter term charts if you're trading oil actively. If you're not, just wait for the market to tip its hand before looking for new trades in the whichever direction you'd like to trade it. And gold. I've got a better chart. Hold on. Yes, I think it's this one. Yeah. So, what do you make of gold, Victor?
Well, it seems as if the recent range has only been punctured, but
yeah.
on both sides,
yeah.
And this consolidation pattern is still intact. The 1760-ish area, and 1810, 10 to 15, I guess. Still seem to be the levels to watch. And the decisive move by the Fed to announce its intention to hike rates next year appears to have caused just a brief selling pressure in gold, and the market has returned to buying gold, betting that the Fed will still remain behind the curve, and precious metals, being an inflationary hedge, have managed to rally somewhat. However, this rally is still not convincing for me, and I'd like to see something more protracted in order to have a more convincing trade.
Yeah, I agree. I think if you're bullish on gold, you'd like to see price break out of this long-term bull flag pattern, if you call it that. We are right at resistance of that flag here. Previously, it attempted a breakout, but it failed immediately, although we didn't see any significant downside follow-through, which has raised hopes that maybe, perhaps, that was a genuine breakout. Let's see. But I'd like to see another attempt, a bullish breakout attempt in gold on the longer-term chart before turning bullish on this precious metal. Until that happens, it's one to keep an eye on, but probably not to be very active in, because of the range bound price action. Anything else, Victor? Cryptos, maybe?
Yeah, sure. Let's have a look at cryptos. We had quite.
Where's Bitcoin?
Where is it?
There you go.
All right. So we had another risk reversal yesterday. So Bitcoin has rebounded, and it seems as if the risk sentiment is precisely what's driving Bitcoin at this point in time. So any claims of decoupling from the rest of the financial markets have been put to shreds, if you ask me. And this asset class is basically just the risk asset of risk assets. So
the riskiest.
So if you look at the chart, it's closely mimicking the troubles that the majority of the constituents of the Nasdaq had over the recent month or so. So basically, what we're looking at here is a range-bound action between 52 and 46 for the time being, at least, and it sure feels as if this market still has ways to go to the downside, although we have encountered the first level of support around 46. We are far from like this downtrend seems to be far from over in my view.
So if you're feeling bullish because of this breakout from the triangle, if you're shorter term focused trader, this level now needs to hold. This is the point of origin of this latest breakout at 47,500 ish. This is kind of area. So that's also the backside of the broken trend line. 50 is going to act as a magnet, I think. I think there's a possibility we could retest 50. What it does thereafter, is going to be at least in part determined by the overall appetite for risk in the financial markets. But 50 is also where the 21-day exponential moving average comes into play. And this exponential moving average is quite important. As you can see, several tests here. We finally broke below it, and since then it has capped the upside. So another retest here, and a rejection is possible, especially because this test will come in at around the psychologically important 50,000 level. So yeah, watch out for a potential reversal there. But if we go through it, then maybe that could be a sign that the Santa rally is here, right? God, I hate that word, the Santa rally sentence. Anyway, shall we wrap it up here? I can't see any questions from the
attendees.
I
guess so. Do we have any questions from the audience, dear audience?
It doesn't appear so.
Yeah, doesn't seem so. Well, with that, we wish you a happy festivities season. Yeah, and we're going to be back with you next at the beginning of next year on the 4th of January, as Fawad already mentioned. Yeah. Be safe. These markets are very illiquid, and sharp moves are not to be excluded from the equation. They can happen really quickly before you know it.
Yes, indeed. So with that, take care, guys, and wish you all the best in the year ahead. Happy holidays and all that, and we'll see you guys very shortly. Take care.